My name's Daniel, and I hope you have enough energy to listen to my paper even before the corona crisis. We talked about catastrophes and the market price, and when I was asked about this, I said yes immediately, and because it's an interesting subject and something which I will provide you some detail on, and it's also, there are very many aspects, different aspects of this subject, and you've heard lots about climate change in the earlier part of the day, and climate change is a very important issue for us in my business, so I'd like to give you some detail on this. Let me start off with a picture of a catastrophe. And so, what do models know? And what's the damage going to be when, if I look at this picture of Hurricane Dorian, and I have a look at that, and the answer is, of course, the models which we use aren't there to predict the catastrophes, but they are. But the models are very good for pricing various parts of the market. It very much depends on. For example, with the case of Hurricane Dorian, if you ask someone in the Bahamas when they've had a hurricane battering their island for 3 days, and if you ask someone from Florida, even though the hurricane approached Florida, but finally didn't have a landfall, the front didn't hit land, and it had greatly reduced in power when it hit Florida. So the catastrophe, the damage in Florida was much reduced compared with Bahamas. So a few miles can make a massive difference to the pricing. In this case, it was several hundred miles and the damages. So in the next 30 minutes, we'll be touching on, for example, how disasters can be priced, which factors do we use, what are the parameters that we need, how do the models work. I'll give you a brief insight on that. I won't make it very technical, and then we'll have a look at where the models are maybe not so good, and then look what the insurance business is doing and where the externalized effects are, and how can one remove or delete these externalized effects. And then we want to look at what governments do and whether capitalism has, how that can help in dealing with these catastrophes, and look at moral hazards, and then sort of have an overarching look at and reflection of this entire conference today. Looking at climate change, it's pretty much omnipresent. We've heard about the various headlines. It's the end of the world, it's the apocalypse countdown, and you just look at the papers and pretty impressive. But today, I mean, for me, I think it's good to have a more detailed look, a nuanced look at the figures and at what actually happened, and not only at these headlines. I've got a few slides with me, and they give you, I think, especially what Mr. Grantham says, to make it more understandable and give you a different perspective, a different look at the whole issue of catastrophes. This is the third time I've said this. If you look at these figures for insurance losses from München Re, you can see it looks like we've got far more catastrophes in the last few years, and they're becoming more and more expensive, and then the catastrophes are becoming more and more unpredictable.
And that is going to be a major problem for the insurance companies. And look at the green part. Those are the overall losses, and they are overproportionate in their increase. The blue ones also increase, but just slightly so. Munich Re has not only given us this number of disasters, but they have also analyzed it. And they said, perhaps it's not only the quantity of the individual cases, but perhaps there are other factors. And the other factors, if you look at them, and here it is the exposures and where are the insured values. And if you adjust them and look at what is the GDP growth in this contributing to this chart, you see that a major part of the trend is seen in the major assets and the larger exposures. And not so much, it is not so much the amount of catastrophes. You have more exposures of the big ones than the number of catastrophes that you see here. So, if you look at if you adjust the exposures, then the trend isn't so extreme. And very important, the insured values, and this is something that you can see very well in the models. Take a look at this. This is Florida. It's a very exposed region for hurricane risks, very high insured values. And we're just at the beginning of a hurricane here. This shows you many things. And here you see there are certain exposed regions where now you have population. People are rich or are better off, and therefore they have more exposed values. And, you know, if you had that hurricane 100 years ago, there wouldn't have been that much damage to individual property. And we always show the growth of the hurricanes or the strength of the hurricanes, but we normally don't have any exposure-adjusted charts. And coming to an end of that, look at the exposure here. There are certain parameters that you have to have in order to make the models work. And if the insurance industry takes this, they say, well, there is a detailed data collection of all of the contracts. And every contract is being shown here. And then you have a pool of different simulated catastrophes. It can be hurricanes, earthquakes, tornadoes, what have you. And this pool is constantly being updated. And then you have a simulation where you say, okay, I take that amount of events and let them run through this program. And then I have a fairly good adjustment, and I have a fairly good image as to what years will be expensive and what years will be without such major losses. And we as a fund or the insurance companies, we're fairly sure that, yes, you can make money. So it's not really a question of nerves of steel, but I basically use financial mathematics and insurance mathematics. But you're right, it takes courage. And if you look at the global increase in population, that is a parameter that we can control. I mean, we know how much it is. Then we have the improved standard of living, especially in China, also other regions in Asia, Brazil the same, India and so on. you have much increase in the standard of living. You have a concentration of people in urban areas. There's an urbanization in many, many parts of the world. People are escaping the countryside. And if you have the connected world, you have very complex delivery chains, and you saw that very well during the Corona crisis, that all of a sudden certain chains of supply weren't there anymore. It's very complex, and these models are difficult, and you have to really analyze very well, is this a risk that we can insure? And if we can insure it, we need to find a price that the client is willing to pay too. The same happens with climate. We see an increase in many places. We have an increase in catastrophes, but we also have an increase in the extreme situations. And these are difficult situations to be modeled. Especially those extreme situations are very hard to show. But the insurance, the private insurance market and the reinsurance market is focused on what can be covered by the model. And if you want to look at the proof of concept, then this is the index for catastrophe or disaster bonds. And you see every year it goes up. We had strong years, 2017, that was the most expensive year. 2005, Katrina, Wilma Katrina, 2011. You see, we were hit hard as the insurance industry, but if you look at the risks that can be modeled, it seems that we have been able to ascertain the right market price. So, this is my temporary conclusion. Yes, I think that, and this is the private insurance market is doing that. We are cherry-picking the risks, and in those you can determine the market prices, and it works. Especially if certain parameters are well understood, and then you are able to apply the model, and then you have to find the right price. The insurer has to be able to charge a price that the client is able to pay, and of course also that gives him the promise of profit that he is anticipating. And the best experiences, with the major wind system, typhoons, hurricanes, earthquakes, there it works really well. These are good risks to be modeling and insuring. Where we see the problems, and this is where we have the global warming situation now. I want to show you that in the next picture. This is where you have the extreme weather conditions. There, the models cannot really be used because very often these are really local events, and we of course are always interested in those things that are globally affecting everybody. As we now have in the pandemic situation, things don't work anymore. Everybody is affected in the same manner, the same, with volcano eruptions or meteorite impact. And there you see that it is difficult to find the right market price. And there usually isn't any clearing price. And I'd like to share this problem with you in the charts to come. And there is no such thing as a market price because, if the insurer doesn't want to provide a price, then we have this incredible increase in the relationship between what is insured and what is not insured. And this is what we call the protection gap. And that's a general effect that we see now. And as society, as capitalism, we must close this gap because it is a threat for our well-being as a country. And I say it very directly, this in conjunction with the climate change, and we heard that in earlier discussions, CO2 emissions trading, all of these problems are things where everybody should participate, and it's not a situation where the free riders should be able to participate. So, the major insurers and reinsurers in Europe made their predictions. Here you look at the external effects. We looked at it in different projections. I don't want to get into individual bits, but 2% climate goal and 5% climate goal have overproportional negative effects on us, and all the insurance gaps are widening here. So if you have extreme weather conditions, if you come from 8 degrees and then you have a factor of 6 or 7, then of course that can be very, very strong. So the bucket image we saw earlier is already has already shown us that we're close to the limit, and we shouldn't add too much to it. I mean, if the icebergs are melting and you have more cyclones, then that's exactly what's going to happen. So, we are now at 3.9 degrees aggregate temperature increase. We're almost in the orange or in the red area of this chart. I agree with my predecessors here that we need to have a concerted global action plan now. And if you look at it from a wider perspective, about 15% of all the investments on a global level are actually at risk by the climate change. And they say that it takes about 2 trillion to still make the right turn. Now, if the overall sum for disaster risks, I mean, only talking about the reinsurance, it's $600 billion, maybe 550 billion euros. If you look at the costs, the secondary effects, they are much tougher than the immediate primary effect that is covered by the insurance. So, it's not only a question of the insured parts that need to be controlled, but also the uninsured part. And this is the focus that I'm speaking for. There's one thing that we do. We see that the governments, after disasters, usually come and try to chip in. And basically what they do is they print more money. And then they build up the infrastructure and try to control the damage, and they try to help their people. But I see also other efforts. The World Bank has continuously increased the sponsored disaster recovery relief program for the poorer countries of the world. and that don't have a government that will actually help their people. And we see that now the World Bank has implemented or is about to implement very positive programs, and we support that, of course. Now, we see that certain catastrophes are hurricanes, earthquakes, big losses, 20, 30 billion, no problem at all. You get that easily in the States. But if you see that in relation to the gross national product, you see there really isn't, this isn't really much. I mean, it's still very local and it is controllable and manageable. If the government then decides to use their own money to help that situation. Now, but when we're talking about pandemics like COVID-19, where everybody is affected in the same fashion, and then look at the amount of money that, that has actually been increasing exponentially. We need huge packages to mitigate some of the effects, and not all of them, by the way. And therefore, the bailouts are not really the solutions or one solution, but it's a dangerous one. And there are major disadvantages involved here. So in the past, we have noticed that many people simply have not invested sufficiently. When I go abroad and I'm waiting for the government to help me, and that works, well then in the next time, I don't worry too much anymore because I simply trust that my government is going to help me out. And that basically is a bad approach because it skews the take on capitalism. And you have to have your money on the safe side. It's a long payback, and at the end of the day, it's a higher cost block for the disasters. And then you add to that the fact that now we see the amount of money and the amount of debts that have been incurred, and that raises two questions. Is this a short-term compensation of volatility, or is it that these are also investments that will be profitable in the future in the sense of protecting the earth and to close that protection gap that I mentioned earlier? And then, of course, the question is, who is going to repay that debt? It's certain that future generations will have to pay for that. And if they don't have a return for the debts that are now being incurred, then that would be really, really bad for future generations.
So this Green Deal from the EU is, they can probably help, undoubtedly help, and are a good idea, I think. Which brings me to my last slide for the day. And I am looking forward to your questions and giving answers to them, and the summary from Dr. Leber. So, is there a market price for disasters? And the answer is yeah, kind of. And there are ways in which one can price a disaster well, where the individual catastrophes are well reflected in the models, and the insurance sector can get prices, and then we have a market price, and that provides good compensation, and the market plays along with that. But I think one shouldn't forget that in today's conversation, in today's topic, climate change is definitely a threat to the market, and despite all, and it's a threat to the wealth and affluence and the functioning of capitalism, and I'm sure it is threatened by climate change, and actions need to be taken place. There need to be resolute actions, and will help us over the long term. And one of them is, I think, that the non-insured sector, which destroys many assets, that is adjusted. Not only the developed world, which can afford to pay that, but also the developing world, third world, whatever you want to call it, that contributions are made there, and that we need to be very much aware that it's not only that protection gap, but the second effect. There are other secondary effects which are even also threats for our overall assets and values. And seeing these global risks, which we are now seeing, the pandemic or a volcanic eruption, do represent a major risk, and we need to have a global coordination in order to reflect those risks, not only at a national level. And so the money printing can help, cannot help. It creates imbalances. So we need a higher level of global coordination. And whatever the large disasters which do require global coordination, that's where there is a risk. And we now need to invest in the future, and especially bearing in mind the debts being made now, we need to make sure that in the future we have good returns on that money. So that's the end of what I wanted to say today, so I'm looking forward to answering your questions. Thank you, Mr. Ineichen, for that. We're going to join you. So we've heard lots about catastrophes, and learned of how they are priced. So what about the long-term risk of nuclear power stations, half-life value and storage? As is a kind of risk be insured or not insured? Nuclear power stations are often not insured, and the external damages from an atomic accident are massive. So if we look at how to price that, I would say it's difficult to price. One could use models, and there are various models with the risks involved. In the end, though, you get a package, for example, of computer chips, and then you look at models and analysis, and look at the price negotiation for the renewal of those contracts. But those contracts last for a year, as I said, so it is the case that the new knowledge from the models, or latest model, or from climate change, and if there is news on that, new data, then that is included in the prices, and you will see that prices have climbed steadily over recent years. There have been in the past massive catastrophes, and payouts were made, and as a consequence of that, the premiums do go up. That is, can you go insolvent? There are various levels in the business. Then 1 billion, 2 billion, whatever. Can the insurance business be knocked out by those kind of? Well, I hope not. Yeah, good point. No, I hope not. The insurance industry is even more regulated than the financial sector, and the risks are scaled, and one diversifies the portfolio in order to, so the level of capital is less than the insolvency capital is reduced by spreading the load. And we have reinsurance, as you know, and that is definitely, there are structures there and incentives there in order to have the insurance. The insurance industry wants to survive too, as the financial industry does. There are various segments where one might have a loss or a failure, but overall I think we can say that the insurance industry is well covered and isn't on the brink of bankruptcy. What about the regions and type of risks? And you said there are uninsurable things, and I won't keep away from them. Don't go near them with a barge pole. So because of global warming, there are other regions being impacted by even greater catastrophes. More people are being hit. They are more affluent. They wish to cover, more and more people wish to cover their risks. And if you have a very specific look, there are three main regions which we look at. The USA, where there's a huge concentration of asset value and lots of insured values. Europe and Japan and Asia, those are the main areas where people have high levels of coverage for their assets and their wealth, and look forward and do insure their value and their assets. In the case of natural catastrophes, we have these models and we can configure prices accordingly. We try to avoid extreme weather situations like tornadoes, floods, or forest fires, where there is a massive influence there from global warming, and those aren't reflected in the market prices. That's where the market is not yet fully up to speed. Then if you look at man-made risks like IT risks, internet insurance and cyber problems, the market is looking for a balance there. But it's a very important area. There's a huge demand, so we're still looking for a balance there. What about COVID-19? How was that impacted on your market? Funnily enough, surprisingly little. It sounds, I know the COVID-19 is a crisis. It's a liquidity crisis. So there is a massive demand from investors. But we are relatively stress resistant. There are deformations taking place, obviously. But the actual insurance damages, the risks which are covered are actually not affected that much, because the pandemic insurance does exist, but it's covered by reinsurance or where we are active. It could have been a lot worse than actually is. A second wave might cause higher levels of damage. So we're focusing much more on natural catastrophes, and so that pandemic hasn't affected us that much. But there are, what about market catastrophe bonds? We are maybe 2% of the overall market for catastrophe is in pandemic risks. So for the market, it's a small scale stress factor. It needs more information there. There was a demand for information, but hasn't actually resulted in major losses. We talked about capital and the insurance market. There's a hedge fund, and they have something covered by a reinsurance, and we sit in the share market, stock market, and money's there. Where's that money coming from? And people are no longer interested in what we're doing. The main thing we're worried about is where the money's there. It's in, it's out. Machines make the decisions, whatever. And now you're saying that you sound like a rational kind of guy. Are there situations where the money arrives and I don't know what to do with the money? You're ruining the prices. What is the inflow side for you, generally speaking? We're involved in about 20% of the reinsurance market. We follow the capital markets. It's a cyclical market. When prime premiums can be relatively high, there's risk capital there, and then if for a long time nothing happens after calm periods where profits have accumulated and then premiums tend to sink. And what we can determine is, in the case of hard markets, after phases of high premiums, then at some point new money does arrive, and that then puts pressure on prices. We've just left a period when it lasted until 16, 17, where it was relative, there was money coming in, and in 17, 18 were difficult years. After that, the wheat was separated from so the good was separated from the bad, and the situation is now is that the capital has slowed down a bit, inflow of capital, so premiums are going up a little, and it's been a very interesting period right now. But it's definitely cyclic. There are times when there's a greater inflow, and then you have to reposition yourself. It's the same as any other market, really. Well, I think that might be. A few years back, it's unethical with the risks and the playing with the gaming other people's risks. Is that? I don't think it's the case myself, but are you sometimes accused of things like that? It's an argument that it's been around. We've heard it. It comes around. It's if you look at it in detail, we're not playing with people's fates or destinies, and what we're doing is actually, if something happens and people have damages, we step in and investors leave some money. If we're not there, then if there's nothing happens, the investors get money. So it's actually a very ethical, basic principle in terms of morals, and I think the ethical impact it earns a positive assessment, and so we're there to mitigate suffering, and we're not speculate on life or death in that sense. You're providing insurance cover, surely, and getting a good price for that insurance cover, so the premiums are reasonable. You were talking about life insurance as a second life market, which was at one point where there was an ethical discussion there. It's a market we have never been active in. Lots of speculation about the life insurance market. You have insurance on one, but the incentive chain was not maybe what it should have been, and maybe that was a problematic sector at the time. The reinsurers, and we need lots of data, and it wasn't something we were very active in. You've been dealing with catastrophes for a few years now. What was the worst catastrophe where you were most surprised by? Can you say what that was? Can you give us an insight there? I know it's when I started, and I'm an economist by trade, I'll be honest, by training, and I used to believe in, I loved the economy, and when I started looking at the strategies, and we came up with our first product, that was in 2008, and on the Friday, we bought we had an earthquake policy in Japan, and then 2 days later there was an earthquake in Japan. Bad start, but luckily it was a very weak earthquake. So yeah, it was very dramatic at the time. But it was the first investment. We were right there on the brink of that investment, and it would have hit us. But luckily nothing happened, and we were able to come up with a model analysts, and they said it was okay. Yeah, but otherwise, it's what I don't like seeing. For me, when the tsunami in India, if it doesn't hit, if it hits the uninsured world, these catastrophes take place in areas where people really do suffer, and we know there's lots of human suffering, and there's no insurance cover, and we have to say, yeah, nothing's hit us, the investors are okay, but if I look at the human suffering, yes, that's not easy for me, and the case of low insurance, and what are you a good investment? It's an institutional product which we offer, and it's sophisticated investors who come into our sector. We see is mainly people who are active in the bond markets or corporate debt. They're trying to reduce their corporate debt and looking for alternatives. We then turn up. Another aspect is where people are looking just for different investment strategies, different looking to diversify their portfolio. So we're active globally, but people looking at global alternatives, Europe, North Europe, USA, Japan, Switzerland. There's a big basis of investors on the institutional side. It's quite often at low levels, though. Anyway, thanks for that. Let's close the catastrophe for today. But not your paper. Anyway, you can stay if you wish, or you can leave the camera. And anyway, we've had a lot of fun. And Dr. Laber, you're getting tips now on getting some power for your e-car. So I'd like to thank Mr. Rockert for that tip on getting some cheap power for your e-car. I would like to. What's your tip for people who've spent all day with us and are still here, our present audience? So what should I do? No, I'll give you a tip right at the end. So I've still got 15 minutes. I want to use that 15 minutes. And this morning I started to praise capitalism, what capitalism can do. I talked about a baker, or what a wonderful example of capitalism that is. Someone doesn't know me, but he doesn't know what I like, but he's just there, but he just wants to make a profit. He offers me a bread roll that I want at the time I want it, at the price it's okay. I think that's one of the wonders of capitalism.